Hello everybody, this is OG John here. Listen carefully. What I'm about to show you isn't a prediction. It isn't speculation. It's something that's already happening, documented in official government reports, trade data, and central bank disclosures. And yet most people have no idea that the architecture of global finance is quietly being dismantled, piece by piece, month by month. November 2025, China's holdings of US Treasury bonds hit $682.6 billion, the lowest level since November 2008. That number should make you stop and think, because in November 2013, just 12 years ago, that same number was $1.316 trillion. Let me be clear about what that means. China has reduced its treasury holdings by $634 billion. That's not portfolio adjustment. That's not rebalancing. That's a systematic, methodical exit from being America's largest foreign creditor, and they're not slowing down. In fact, they're accelerating. But here's where this gets fascinating. While China is selling American debt, they're buying something else. Something that can't be printed, something that can't be sanctioned, something that's been considered money for 5,000 years. Gold. 14 consecutive months of gold purchases. From December 2024 through December 2025, the People's Bank of China added to their reserves every single month without interruption. Their official gold reserves now stand at 2,306 tons. That's 74.15 million troy ounces. And gold now represents 8.5% of China's total foreign exchange reserves, up from roughly 4% just 3 years ago. But here's what you need to understand. Those are the official numbers. The ones China reports to the International Monetary Fund. Independent analysts who track global gold flows, warehouse movements, and trade data estimate China's actual gold reserves are substantially higher. Some estimates put the real number above 5,400 tons, more than double what's officially reported. Why would China hide their gold purchases? Think about it. If you're systematically building the largest gold position in modern history while simultaneously exiting the dollar system, you don't advertise your strategy until the infrastructure is complete. You acquire quietly, you build in secret, you launch when you're ready, and the infrastructure is nearly complete. November 19th, 2025, a date that received almost no mainstream media coverage. The chairman of the Central Bank of the United Arab Emirates completed a landmark digital currency transaction with the governor of the People's Bank of China. They officially inaugurated Project mBridge, a cross-border payment system that allows participating countries to conduct bilateral trade in their own currencies, completely bypassing the US dollar. This isn't theoretical. This isn't a pilot program. This is operational. Thailand, UAE, Hong Kong, and China are already processing transactions, and the system is designed to expand. Saudi Arabia is involved, Indonesia is involved, the entire BRICS Plus alliance is watching this infrastructure come online. But let's go back to those treasury sales, because the scale is staggering when you zoom out. From 2013 to November 2025, China reduced holdings from $1.316 trillion to $682.6 billion. That's a 48% reduction. Nearly half of their position liquidated over 12 years. In July 2025 alone, they dumped $25.7 billion, the steepest reduction in nearly 2 years. September saw another significant drop. October, another $11.8 billion sold. November, another $6.1 billion gone. Month after month after month, the exit continues. Meanwhile, Japan increased their treasury holdings to $1.2 trillion. The United Kingdom raised holdings to $877.9 billion. They're buying what China is selling. But the question nobody in Washington wants to address is this: what happens when Japan and the UK stop absorbing the supply? What happens when China's selling accelerates beyond what friendly nations are willing to purchase? Interest rates spike. The US government's borrowing costs explode, and America's national debt, which just crossed $36 trillion, becomes increasingly expensive to service. The interest payments alone now exceed $1.1 trillion annually. That's more than the defense budget, more than Medicare. And with rates climbing, that number is only going to grow. But China isn't just selling treasuries and buying gold. They're weaponizing industrial supply chains. In January 2026, China implemented export restrictions on silver. Not a ban. Restrictions. Licensing requirements. Quotas. The kind of controlled release that creates artificial scarcity while maintaining plausible deniability. Why silver? Because silver is unique. It's not just a monetary metal, it's an industrial necessity. Electric vehicles require silver. Solar panels require massive amounts of silver. Advanced electronics, semiconductors, 5G infrastructure, all of it requires silver. And China produces roughly 12% of global mine supply while consuming nearly 25% of annual global production. When those export restrictions hit, the price premium in Shanghai exploded. Western spot prices were trading around $80 per ounce. Shanghai prices, over $100, a 26% premium. That gap represents a physical shortage. That gap represents desperation among industrial buyers who need silver and can't get it from their usual suppliers. Now connect the dots. China is the world's largest solar panel manufacturer. They dominate EV battery production. They control rare earth processing. And now they're restricting silver exports. This isn't about profit margins. This is about controlling the physical inputs required for the energy transition. This is about making the West dependent on Chinese supply chains for the technologies that will define the next century. But let's talk about what's happening at the BRICS level, because this isn't just China acting alone. This is coordinated. Brazil added 43 tons of gold over September, October, and November 2025. 3 consecutive months of purchases. Their total reserves now stand at 172 tons. For Brazil, a country that hadn't purchased gold since 2021, this represents a fundamental policy shift. Poland went from 103 tons of gold in 2018 to 765 tons in 2024. A 7-fold increase in 6 years. Turkey now holds over 600 tons. India accumulated 876 tons. Russia's official reserves exceed 2,336 tons. The pattern is clear. Central banks around the world are accumulating gold at the fastest pace since the 1970s. In 2025, central banks purchased over 800 tons of gold. For context, annual mine production is roughly 3,500 tons globally. Central banks are absorbing nearly a quarter of all newly mined gold. And here's the critical insight. These purchases are occurring despite gold prices hitting record highs. Gold exceeded $4,300 per ounce in October 2025. It's trading above $4,400 in early 2026. Traditional economic theory says demand should decline at high prices, but central bank buying accelerates because they're not buying based on price. They're buying based on strategy. They're buying based on the recognition that the dollar system is fracturing. The IMF quietly confirmed this in June 2024. For the first time in nearly 3 decades, foreign central banks' collective holdings of gold surpassed their holdings of US Treasuries in value terms. Read that again. Gold holdings exceeded Treasury holdings. That's a tectonic shift in how the world stores wealth. But here's where this gets uncomfortable, because the US government's response to all of this has been to double down on fiscal insanity. The deficit in 2025 exceeded $2 trillion. That's not wartime spending. That's peacetime borrowing at levels that would have been considered impossible a decade ago. The debt-to-GDP ratio now exceeds 125%. When Paul Volcker raised interest rates to 20% in the early 1980s to crush inflation, the debt-to-GDP ratio was 30%. The country could afford the pain. Today, that same strategy would be suicidal. Every percentage point increase in interest rates adds hundreds of billions to the annual interest expense. So the Federal Reserve is trapped. They can't raise rates meaningfully without causing a fiscal crisis. But they can't cut rates without risking inflation spiraling out of control. And foreign creditors are watching this dilemma unfold in real time. China sees it. Russia sees it. The BRICS alliance sees it. And they're building the infrastructure to operate outside this system before it implodes. On October 31, 2025, researchers launched a pilot test of a gold-anchored settlement unit inside the BRICS Plus block. This wasn't a press release. This wasn't a political speech. This was a functional prototype, a digital trade currency backed 40% by gold and 60% by a basket of BRICS currencies. The basket adjusts daily based on trade flows and currency values. On December 8th, they launched a full prototype, operational, functional, ready for scaling. The implications are staggering. If BRICS countries, which represent 47.9% of global population and 37% of global GDP, measured by purchasing power parity, begin settling trade in a gold-backed digital currency, the demand for dollars evaporates, not gradually, rapidly. Oil transactions denominated in yuan or this new BRICS unit, commodity trades settled without touching the dollar, industrial supply chains operating entirely outside SWIFT, the petrodollar, the foundation of American financial power for 50 years, becomes irrelevant, and here's what keeps strategists awake. India is hosting the next BRICS summit in 2026. The agenda is focused on expanding BRICS Pay, the cross-border digital payment system. Indonesia just joined as a full member. 11 new partner countries were welcomed: Belarus, Bolivia, Kazakhstan, Nigeria, Malaysia, Thailand, Vietnam, Uganda, Uzbekistan. This isn't a fringe movement. This is becoming a parallel global financial system, and it's gaining momentum faster than most analysts predicted. Now let's address the counter-argument. Because there are legitimate reasons to be skeptical. India's External Affairs Minister stated publicly in March 2025 that India has no policy to replace the dollar. He said, "The dollar as the reserve currency is the source of global economic stability. Right now, what we want in the world is more economic stability, not less." That's true. India isn't advocating for violent de-dollarization, but they are building the infrastructure to operate without the dollar if necessary. They're hedging, they're preparing, because they watched what happened to Russia after 2022. When Russia invaded Ukraine, the West froze hundreds of billions of dollars in Russian foreign reserves. Money that Russia thought was safe, held in Western banks, became inaccessible overnight. That event sent shockwaves through every central bank on the planet. Because if the West can freeze Russian reserves, they can freeze anyone's reserves. China holds $3.36 trillion in foreign exchange reserves. If even 10% of that is at risk of being frozen due to geopolitical tensions over Taiwan, Hong Kong, or trade disputes, that's $336 billion of vulnerability. Gold stored in Beijing cannot be frozen. Digital yuan cannot be sanctioned. A BRICS payment system cannot be disconnected by Western governments. This is about sovereignty. This is about control. And the trajectory is undeniable. But there's another dimension to this story that almost nobody is discussing. And it involves what just happened in January 2026. January 30th, 2026. Gold plummeted 9%, the worst single-day decline in decades. Silver, complete carnage, a 26% wipeout, the largest single-day loss ever recorded for silver. Mainstream media attributed this to dollar strength following Fed nomination news. But look closer at the data. On that same day, Chinese retail investors who had piled into leveraged silver positions got obliterated. Margin calls cascaded through Shenzhen trading houses. Hedge funds bled billions. And yet, amid this bloodbath, China's central bank quietly continued buying. They added 30,000 ounces of gold in December. Another purchase announced in January. Methodical, systematic, unaffected by short-term price movements. That tells you everything. The price crash was noise, forced liquidations, speculative excess being purged. But the strategic buyers, the ones operating on decade-long time horizons, they didn't flinch because they're not trading, they're accumulating. And here's what makes this moment so dangerous. The gap between paper prices and physical availability is widening. Sovereign mints are running 8 to 10 week delivery times. That's up from 2 to 3 weeks just a month earlier. The Perth Mint temporarily shut down new sales to catch up on existing orders. The Royal Canadian Mint is rationing supply. European mints are struggling with blank shortages. And premiums are spiking even as spot prices crashed. This is the classic setup for a supply crisis. Paper markets can be manipulated, futures contracts can be dumped, but physical metal cannot be created out of thin air. And when industrial demand collides with investment demand, collides with central bank accumulation, supply chains break. China understands this better than anyone because they control the refining capacity. They control the processing infrastructure, and they're positioning themselves to control the price discovery mechanism when Western paper markets lose credibility. Now imagine this scenario. It's March 2026. The BRICS summit announces operational deployment of the gold-backed settlement unit across all member nations. Saudi Arabia, which has been quietly accumulating gold for years, announces they will accept payment for oil in either dollars, yuan, or the BRICS unit. Within 24 hours, every oil-importing nation on Earth is scrambling to acquire whatever currency mix gives them the best pricing. Some will stick with dollars, but many won't, especially countries that have been threatened with sanctions or tariffs. The demand for dollars decreases by 10%. That seems manageable, but remember, the dollar's role as reserve currency is built on network effects. Everyone uses dollars because everyone uses dollars. When that circular logic breaks, it doesn't degrade slowly, it collapses rapidly. Treasury yields spike. The U.S. government's borrowing costs surge. Inflation accelerates as import prices rise. The Federal Reserve faces an impossible choice: raise rates and cause a fiscal crisis, or print money and destroy the currency's credibility. This isn't science fiction. This is game theory. And China has been positioning for this endgame for over a decade. But here's what the data can't tell us. Here's what keeps analysts uncertain. We don't know the timeline. Does China have 5 more years of patience? Do they need 5 more years to finish building the infrastructure? Or are they already ready, just waiting for the right geopolitical moment to trigger the transition? We don't know if BRICS will stay unified. India and China have border disputes. Russia and India have complicated relations. Brazil's political leadership changes could shift their stance. This alliance could fracture before reaching critical mass. We don't know if the dollar has more resilience than skeptics believe. America still has the most liquid capital markets, the deepest bond markets, the most advanced financial infrastructure. That's not easy to replace. But here's what we do know. The trajectory is clear. The data is undeniable. China has reduced Treasury holdings by nearly 50% over 12 years. Central banks globally are accumulating gold at record pace. Alternative payment systems are operational and expanding. The dollar's share of global reserves has dropped from 73% in 2001 to 54% in 2025. This is not a drill. This is not a conspiracy theory. This is documented, verifiable, systematic de-dollarization occurring in real time. And the question that should terrify every American, every holder of dollar-denominated assets, every pension fund manager, every institutional investor is this: when does gradual transition become sudden collapse? When does strategic repositioning become market panic? When does the world's reserve currency lose that status? Not over decades, but over months. Because history shows us that financial system transitions don't happen smoothly. They happen in crisis. The British pound lost reserve status rapidly after World War II, not gradually. The gold standard collapsed suddenly in 1971, not incrementally. These shifts occur when the gap between reality and perception closes violently. And right now, perception is that the dollar system is stable, functional, permanent. Reality is that the architecture is being quietly dismantled by the world's second largest economy, with cooperation from dozens of other nations representing half the global population. The fuse is lit, the clock is running, and the only question left is whether you'll be positioned for what comes next, or caught completely off guard when the system most people take for granted simply stops functioning the way it always has. What happens next isn't written yet, but the pieces are in motion, the players have chosen their sides, and the endgame, whether it arrives in 2026 or 2030, will rewrite the financial order that has governed the world for the past 80 years. Are you watching the right numbers, or are you still believing the narrative? OG John this side, signing off.